Welcome to Investors Insights. My name is Greg Powell, President and CEO of Five Plan Partners, and our topic today, feeling richer? Question mark. I'm joined by my distinguished colleagues, Trey Booth and Bobby Norman. We've just come out of our portfolio strategies meeting. It's been very productive, and I think you're going to find the information invaluable to you, especially here in the month of July. So, feeling richer. We're going to talk about the numbers. We're going to tell you what we're seeing and let you answer that question. So first of all, Bobby, you talked about bonds. We've got people constantly talking about the stock market, but bonds play an integral part in portfolio strategies. So talk to us about bond strategies at this point in time.
Yeah, like you said, we've been talking about stock market a lot recently. So I want to give an update on the bond market and more specifically how bonds have fared in the past few years. Bonds are obviously valuable because they can help reduce risk, provide income, and improve diversification within investment portfolios. And as you can see in this chart, going back to October 19th of 2023, the total returns of the 11 major bond indices have been impressive. And we chose this as a starting date because the 10-year Treasury note closed at its most recent high of 4.99% on October 19th of 2023. And we need to point out that the 10-year Treasury notes yield fluctuated over a broad range since then. So falling to 3.62% on September 16th, 2024, which is the most recent low, and before climbing to about 4.5% on July 10th of this year. So at its current observation, the 10-year Treasury notes yield represents a decline of 43 basis points from the high. And lower benchmark yields are reflected in the positive total returns in today's chart because fixed income prices and yields typically move in opposite directions. And as you can see from the chart, bonds have, for the most part, been a positive investment in portfolios, with some bonds returning over 20% since October of 2023. So we'll be following inflation. Trey's going to talk about inflation and the Fed carefully in the coming months to see if bonds will continue to perform well based on their objective and where they fit in our clients' portfolios.
Yeah, and I thought that was great that you brought that up this morning because it's all tied together. I mean, people talk about inflation, but in terms of interest rates, and how the yields on stocks also work, dividend yields in relation to those interest rates, what bonds are pricing in. And so it's all connected. And we had the CPI Consumer Price Index come out. And Trey, you're going to talk about that, but it gives us a gauge about inflation. The question is, are people feeling richer? So talk about that.
Yeah, thanks, Rick. So we got the latest Consumer Price Index data came out last week, and the numbers were actually negative, which means the Consumer Price Index went down by 0.4%. And that's really unique because traditionally what you hear economists talk about when they talk about inflation coming down, the inflation actually doesn't come down. It just grows at a slower pace. So when inflation is growing at 3% and then it goes to growing at 2%, they say inflation came down from 3% to 2%. But the prices didn't actually come down. They just grew at 2% year over year instead of at 3%. We actually saw prices go negative. So they actually came down. And that's relatively unique. We haven't had a negative CPI print on a month-to-month basis since COVID. And you can see in this chart over the last 10 years, it's very rare to see prices go negative. But it's a good sign. It means that once prices go up, they don't have to stay there. They actually can come down. And so while this may be temporary, a lot of this was driven by the prices at the pump with the gasoline and then oil futures and everything kind of flowing through from the Iran conflict. That does seem to have heated back up. Oil is back at 83. It's nowhere near above the $100 a barrel that it was earlier in the conflict. So this may not be just a one-time situation, but it is good to see that prices, once these normalize, when we do have a normal environment, a normal global energy environment, normal geopolitical environment, prices actually will be lower, not just grow at a slower pace, but actually will be lower than they are today. And that's a good sign for consumers. But even with that, because we also saw the consumer sales, the retail sales, actually increase in the month. Traditionally, we get monthly consumer sales, and you have to back out inflation because consumers spent 1% more this month, but prices are up 1%. So you didn't actually buy more. You didn't actually feel richer because the dollar you had things went up, but you didn't get more stuff for that price. We saw prices go down this month, and consumer spending went up 0.22%. So that means that you back out consumer price index dropping 0.4. Consumers actually spent 0.62% more month over month. So that's good, because we were talking early in this inflation spike that what we were worried about is a flow through of higher energy prices, what's called demand destruction. You've got to fill up your tank of gas. If that tank of gas costs more, it creates demand destruction in other parts of the economy. People spend more on gas, so retail sales go up, but they spend less on everything else. So we saw prices come down and retail sales continue to go up. So that means demand continues to grow, which is a good sign for the economy. So while the conflict has heated back up, we have seen prices go back up. This is kind of a 1 month view into what will it look like once things subside and we're in kind of a normal economy. Likely see energy prices down, and the consumer is still on good footing, even with all this uncertainty around prices of fuel and energy through the summer months. This is a really good sign that consumers continue to spend. There has not been demand destruction, and prices can come back down. So I don't want to read too much into one report, but it is a fascinating dig into where the economy is, kind of a look through of a normalization. Is very positive for the stock market, for bonds, where interest rates are going, where prices are going, very positive all in all.
Yeah, very much so. And we were discussing earlier, my family's had the opportunity to go down to the beach, down in the Gulf here in Alabama. And I was amazed at how many people I met from Missouri, from Kansas, from Texas. They're driving to get to these locations. If you want to do your boots on the ground research, as I like to say, and I am a nerd, and asking people, well, that must have cost you a lot, just gas alone. Nobody was really complaining about that. And they were still bringing families on vacation, and traffic was very heavy. So I say that to point out to people, through the years of my career, people will say, well, I'm seeing this, I'm seeing this. You can do your own boots on the ground research, as we're talking about, plus looking at the data like we're looking at, to determine that consumers are confident right now, and they feel very good, and they're trying to get that last minute trip in before school starts back up, or as we go into the fall. So a lot of positive news. And as Trey said, it's one report. We're going to keep you updated on this report. And not only that, but other topics through our social media, through Instagram, which is one of our new ones, LinkedIn, Twitter, Facebook, YouTube, on our podcast. We want to make sure that you're getting all the information and data, so that whatever's coming out on the news, you're actually seeing and hearing from us how we're reacting to that or looking at that down the road in relation to your portfolio. We hope you continue to have a great July, that you're out there enjoying yourself, spending some money, and helping this economy move along. And we appreciate your viewership. We appreciate the way you're forwarding it to others. It's made introductions for us, and we will keep you updated. Have a great week. Thanks.